G'day, Internet. Max right here, and I'm super excited to have Dr. Jeff Ross here from Belshire Capital. Jeff, thanks for being here again, man.
Yeah, Max, anytime. I'm glad to be here again.
Um, let's talk about. So we're recording this the day after on Thursday, May 4th. So it's the day after the FOMC meeting. We had the announcement, 25 basis points, but an indication that we're going to pause. How did you read it?
About the same. So I think they want to remain because inflation is remaining sticky high for longer. That continues to be their primary focus.
Mhm.
He continues to say, Powell, when I say he, Powell continues to say that they're going to remain sticky hawkish for longer. So I agree that it looks like they're at an end or near an end. The futures markets agree, by the way, the CME futures markets, which I watch, they're already saying that it's going to, for the next meeting on June 14th, that it's going to be, there's an 84% probability that it will remain where it is, so no change. And then they're already saying as of July 26th, which is the following meeting, that they're calling for a 25 basis point cut. And then they're giving that a 57% chance. So that's what the markets say. They change as data comes in, so that's nothing written in stone or anything like that, but it's very interesting to note that the market thinks that they're done now. So we'll see if inflation data continues to come in hot over the next 6 weeks. The markets will change. If markets, I would say, if risk assets really rip from here, they may say, you know what, there's too much froth still, and that gives us more room. And if unemployment, importantly, continues to stay low, that will give them room to hike again. But for now, at least as of today, as of May 4th, the markets are saying they're done hiking.
Do you think that unemployment number is that the main thing they're hanging on to that's giving them confidence, like we can keep going should we need to?
He has been using, as you know, unemployment and PCE, basically inflation, as his, even though they're both very lagging indicators, he's using both of those as his excuse, let's say, to continue to remain quite hawkish. I think for those of us who look ahead, market participants, we're like, but look at what's coming, look at what regional banks are doing. The economy is grinding to a halt. Blah blah. Housing market has basically just frozen solid. Are you sure this is the right thing to do? And I just think it gives them an excuse to remain hawkish. So it's pretty easy when you say, I'm going to use these two data points. They're both lagging, yes, but that's what we use. He can continue to say, look, I've been saying this for a year now, that I'm going to look at unemployment, and based on unemployment, the economy remains quite strong. And I'm going to use PCE, and inflation remains still hot. It's still well above our 2% target. Therefore, that's all he needs to do. Therefore, we're going to continue to hold rates high. We're going to push them as high as possible and cause as much pain as possible. So I look at it as there was too much, at least from their point of view, too much froth and liquidity in the system to begin with. And now they're basically choking the life out of the credit markets. And then one step further, the actual like equities, stocks, real estate, private equity markets as well. And we're seeing the sequelae of that right now.
Yeah, so there's a lot of fun things to talk about here. Let's start with the banking crisis as it unfolds. So we've just had another bank, I think in the last 24 hours, like stock price plummeted like 60%, and the final nails are being nailed into its coffin. What's your overall thought now? I've talked about this before. You're not much for the conspiracy theory stuff. I certainly am. I'm like, well, this is they love this. The big banks are protected. The small banks, they just get consolidated. You get a consolidation of power. All the big players in DC are happy. How do you feel about this? Are they particularly scared or fearful about a banking crisis? Are they like, this is, or are they secretly saying, this is great? Small banks get absorbed by my friends and get bought up for pennies on the dollar. Let's keep going.
Yeah, this is where I would sort of lean towards you and agree with your conspiracy theories, that I think that the government wants nothing more than to have its tentacles into everything, especially all things monetary and finance related. So they want their tentacles in banks, and it's much easier to have your tentacles in 4 large banks than it is to have in several thousand smaller regional banks. And so I think they're like, yep, well, that's too bad. They show almost no remorse for what's going on. They don't care. They don't care that regional banks are going down. They'll say, look, we're protecting the depositors, right? Nobody's losing their deposits. But if you're an equity holder in these regional banks, if you're the bank itself, you're going down and they're not shedding a single tear. So I think, yes, if this is a conspiracy theory, I think they have no problem with the consolidation that is happening. And then as a personal, I've been tweeting my frustrations out about this. Personally, as a small business owner, I will tell you that there is no love for small business owners from the government. The president just came out claiming they invest in small business in America. They do not. They hound, they regulate, they tax to death small business owners. And if you die, they're like, sweet, one less thing I have to think about, And if you get absorbed by a larger company, they're like, great, that makes it much easier to regulate and to force compliance on.
Yeah, they brutalize you with just petty forms, and it's just an endless the amount of time entrepreneurs have to dedicate to just satisfying stupid bureaucracy it's crippling. Leaves no time to actually grow the business. So 100% with you on there. So I actually went and did the research on this because I was curious, and I had the data loosely in my head, but I went and actually found out the real numbers. So at the time of the Great Depression, at the beginning of the Great Depression, there were 27,000 banks throughout the US. By the time the Great Depression had ended, let's say a decade later, it had gone down to 14,000 banks. And it actually stayed there pretty consistently for quite a few years. And then I forget the exact timing, but it started to move again somewhere around the 80s, I believe, maybe 70s, 80s. And it's whittled all the way down now to, I think, about 4,000 banks. So from 27 with probably a third of the population, if not less, 27,000 banks with a third of the population, whittled all the way down to 4,000. And I think now we're going to go into the next big wave of consolidation, little banks, poorly run banks, et cetera, getting gobbled up. This doesn't fare well for consumer choice. For a healthy growing economy, you want a large middle class, lots of little businesses. You don't want two or three, giants. How does this bode for America long term? Is there anything we can do as citizens to reverse this trend?
Well, as a capitalist, I hate to see it. And I think you're right. That the next wave of the trend started in the 80s with the savings and loans, the S&L crisis. Same kind of deal. They got kind of smoked by interest rate policies and things and got stuck holding bags. But here we are. We continue to consolidate. There's always two things, right? What's good for the state and what's good for the citizens. And what's good for the state is to continue to consolidate. The state wants to continue to grow. They want to continue to regulate. They want to watch everything that's going on. They say it's all in the name of consumer protection. They always do, right? Where they're protecting us poor consumers and citizens with more regulations and having more watchdogs and less of these regional banks to deal with. What can we do? Honestly, not much. I think the way this is headed, and it's not going to happen this year. This is like as you say, this goes back to about 100 years when there were so many banks, and it's been a long, slow but steady process, kind of like the decline of the U.S. dollar, like in value. Like it's a long, slow, steady process downwards. So I think we go more and more. We get consolidated more and more because of these government and Federal Reserve policies. And it's terrible for competition, obviously. And I think the end state is basically having state-run banks, similar to how we have utilities. Basically, they have monopolies that are state approved and watched. And from an investment standpoint, they're terrible investments, right? I mean, you could maybe think of it like a utility or a bond, and you could invest in banks and maybe get, a little bit of a dividend, and it would be very safe. But yeah, as far as competition, as far as progress, those kind of things, I think it's terrible from that standpoint.
Let's cast our minds now to a topic I haven't heard brought up in a while, but it's the concept of bail-ins. If we take our minds back to 2013, Cyprus goes through a banking crisis. And at the time, the two major banks on the country island of Cyprus go down all in the one weekend. For 3 weeks, no one has access to any of their money at all. ATMs are closed, banks are closed. They go away, have some discussions, come back out, and the ECB does a deal with Cyprus and says we're going to do a bail-in, which means these banks are completely insolvent. The only way we solve this problem is we could bail you out. That's the taxpayer giving you money to make the bank solvent. We're not going to do that. We don't care enough about Cyprus. We're going to do bail-ins. All of the depositors gets their accounts chopped in half. If you had $1 million in there, you've now got $500,000 in there. If you had 2 million, you've now got 1. And I remember I followed this story for the couple of years after, and at the G20 summits and all these things, a lot of the big companies, US included, kind of talked about this model and liked this model and put the laws on the books to make it possible in their country as far back as 2014, 2015. So they liked the model. Having said that, I think Well, question for you: do you think we're going to get bail-ins here, or in first world countries, in big banks around Europe? Is this a possibility? Do you think? And if it's not a possibility, how has Bitcoin played a role in this? Because there was no alternative. I think if a bail-in ever came, and if in a major bank in a major first world country and depositors just lose half their money, you're going to see the price of Bitcoin go absolutely parabolic. And I think Bitcoin's taken this option away from them. What are your thoughts?
Absolutely. I think there'd be no better marketing for Bitcoin than to do a bail-in in the United States. So do I think it will happen? Probably not, but there's a chance that it could happen. I mean, the conditions are ripe for it. I think the regulators, as lowly as I think of them, they're not that stupid. Like that would be a death blow. Like you do not do that. That's where you basically erode all trust. There's no more any trust at all in banks at that point if you do that. And so people are already scared enough. I think I just heard a poll today, maybe a Gallup poll. 50% of Americans are very concerned about the safety of their money in banks right now. So Americans are actively looking, even the people who don't normally think about such things. It's on the headlines. They have friends who have been affected by it. They're watching what's going on in the news. So they're concerned enough that they're starting to move their money out of traditional banks. And that's why we see, and I think we're going to continue to see one regional bank after another continue to topple and go into FDI receivership and then get purchased by another bank and continue to consolidate, as we've been talking about. PacWest is the latest that's going down kind of as we speak. And so people are getting scared. And so that, again, there's no better marketing for Bitcoin. I tell people, like, it's legal for banks to do bail-ins. We think that if we put our money there, that they're protecting our little pile of cash in some super secure vault. And if we want it, they're like, sure, here you go. That is not how banks work. You are lending them your money when you give it to them. And there is a chance that if things get really hairy, they can literally just take your money, and that's too bad for you. So will it happen? Super unlikely. Could it happen? Sure. I would give it like, maybe a 1 or 2% probability of actually happening in the United States, just because of the repercussions would be so severe.
Yeah. And for people at home, that might bring the question to people. It's like, well, is there an alternative? Can we find banks where we can actually, the money is there and they do just protect it? Maybe we even pay fees to do that. And the answer to that is basically they have been completely regulated out of existence. They just do not. Banks, there are people who have tried to get those banks done and apply for bank charters and get permission to operate as banks, and with that model, and they just do not get approved. The banking cartel at the Fed will not allow it. So every bank that is allowed to exist must compete on this playing field of keeping your money not safe by lending it out, trying to get it protected, trying to get a higher rate of return, fractional reserve banking, etc. All of that. So it has to be, it's designed that it has to be the riskiest situation. So that's an interesting one. So now when we get ourselves to the point of, okay, protecting our money. So you in your opinion, you think the money is pretty safe in banks, even in the little small ones? Like, do you think, when Signature went down, they came up with this facility, and there's this famous clip about Janet Yellen being, I think it was in front of Congress or something at some committee, saying that with a super majority from the Fed board, in conjunction with myself and the president, we will decide which banks get bailouts and which banks don't. And the answer if the answer is no, you don't get a bailout, that means depositors suffer. Do you think is there any, even the little banks, do you think they might let a few suffer and take some losses? Smack everyone on the knuckles for putting their money in small banks. Put your money in big banks is the clear message. Do you think they'll let a few small banks go, or just not at all?
I think not at all, personally. That's my opinion, because they're talking about this already. In fact, the latest, I believe yesterday, it came up again. Should we just insure all deposits? And that's insane if you think about it. If you know how this stuff works, the FDIC insurance right now covers about 1% of the nation's it's over $17 trillion worth of bank deposits.
Mm-hmm.
The FDIC insurance is about 1% of that. So they're talking about raising it from 1% to 100% coverage. That's crazy. And there's no possible way they can do that other than to completely backstop it with the Fed's balance sheet. If they do that, I mean, we're talking QE amazing, right? I mean, if that starts happening and things get that scary, that's when we just take things to a whole new level. And so what we're going to see is basically just massive debasement of the currency at that point. So that's something that I think is actually kind of, I would expect them to do something like that, something that stupid, something that would be that monumental. is to come out and everybody would cheer and applaud because they say we're covering all deposits. It's you have no risk now. I mean, to say you have no risk, that transfers all the risk to the Treasury and the Fed, and what that means, right, is just massive debasement. And so at that point, you got to figure out what can you get into that will not debase as quickly. That will be the inverse to the US dollar. Obviously, the answer, I think, is Bitcoin. Gold, I think, will perform pretty well if that happens. Some hard assets, I think, would do well. Like commodity type things should do pretty well in that circumstance. But man, these are the kind of things that happen when you're in the end stages of a circus world, right? The end stages of the Keynesian economic experiment. We're seeing the volatility, we're seeing the crazy ideas that people are bringing up to save the system, to patch the system, and at some point people just start to lose faith in it. They're like, this is crazy. Like, I can't believe the decisions that are being made. I can't believe this weekend we're going to have another emergency meeting about what to do with more collapsed banks, even though they keep telling us the banks are strong and resilient. Like, are you sure? It sure seems like they're not strong and resilient. So anyways, it would be really funny if it weren't so tragic, but it's mostly just tragic, I think.
It reminds me of the saying when they say everything's guaranteed. What that means is everything is guaranteed until nothing is guaranteed. And a capitalist system, there's supposed to be booms and not booms bust, but business is succeeding, business is failing, and there's a constant regeneration of bit. But when you start guaranteeing things, bail out, and things are too big to fail, all of a sudden everything's too big to fail until it all fails all at once and is catastrophic. So that so for the person who's thinking ahead here, and it's like, okay, and it could be 6 months, could be 1 year, could be 10 years, could be 20 years, but there's problems here. How do you go ahead and protect your wealth? What's your strategy here? How do you actually think about that in doomsday circumstances? How do you protect your wealth?
Sure. So I think the 4 easiest things to do right now. Well, okay. So first of all, just sitting in cash when you see everything go down is a great strategy, but now it's not even safe necessarily to sit in cash in a bank account. I mean, we should be fine, right? If the FDIC insurance covers up to $250,000 per account. If you have more than that, then my first recommendation would be put cash in multiple bank accounts, because then it should be covered by your FDIC insurance. But 4 alternatives that I see that people are kind of already starting to flock into and figure out. One is money market funds, right? You can move your money into a money market fund. They tend to be safer and a better alternative and offer a pretty good return right now. They're yielding about 4.5 up, some even closer to 5%. That's one. 2, just buy treasuries, short-term treasuries, right? You can go to Treasury Direct, I think .gov, I believe it is, and buy a 2-year treasury that's yielding 3.69% right now, or a 3-month treasury is yielding 5.08% right now. That's easy to do. It's very liquid. It's risk-free, sort of, for the most part. So that's a second alternative. Third, Bitcoin, right? You be your own bank. I think that's the best of them, even though I mentioned it third. Put your money in Bitcoin, put it in cold storage, get it out of the banking system, be your own bank. That's the whole purpose of Bitcoin, is that we're creating this new decentralized banking network, and the banks are just individuals who have their Bitcoin in cold storage. It's literally going to be a totally parallel financial and monetary system to the one that exists right now based on the US dollar. And then fourth, gold. I'm a former gold bug. I know that older people like boomers tend to relate more to gold. I get that. It was the best alternative before Bitcoin was invented. It's been a stable store of value for thousands and thousands of years. Totally commendable. That's awesome. It will not do as well as Bitcoin, but it also doesn't carry the baggage, the political baggage that Bitcoin does as well. So that's an option as well. So those are the 4 things I would recommend.
On the topic of gold, we've got gold here, triple topping around 2060 here. Are you sensing a breakout soon?
So I think it's a little bit overbought at the moment. It's been very strong, and it's in a very strong, legit bullish trend. I'm a momentum guy, as you probably know. I look at long-term and short-term momentum indicators to base my decisions. So I've been long gold for a while. I think it still is a great place to be in, but at these levels, sitting at it right now, 2049 on my chart, I think it's probably going to take a break here at some point. And cool off, but I definitely am a net buyer. So if there's any sizable dip, I would be a buyer of gold.
Okay. And let me introduce you to a concept here. I need a cool name for it, like dollar milkshake theory. Maybe we can come up with one before we come up here. But here's I look at all the things on the wall. We've got commercial banking crisis, and yeah, commercial real estate crisis. We've got the banking crisis. We've got the de-dollarization and the BRICS getting together to do that. We've got geopolitical issues with the war in Ukraine, China being all aggressive with what's his face, Taiwan. Sorry, China being aggressive with Taiwan. I could just go down the list. We can go on. There's an avalanche of issues, and I look at every single issue, and I try and figure out. So what's going to happen. And I come every time I see this, like the tick sign, like as in, when a teacher gives you a tick or a cross next to your answer, a tick sign. And with every single crisis, I see the initial response because I'm thinking about Bitcoin, the initial response being probably a hit, but within a very, very short amount of time. And it depends on the crisis. It could be days, it could be months, could be like a year. But in all of these issues, I see a down crisis, and then, this is what Bitcoin was built for. It's to solve this problem, and it comes back. And I'm thinking like the Bitcoin bungee formula. It comes down but springs back. With every one of these crises, as they hit, there'll be a liquidity crunch. There'll be fear in the market. There'll be, oh my God, it's risk off, and the price of any of these things happen. China invades Taiwan. It's like, okay, boom, war started, problems. Risk on assets are going to do poorly, which is still how people perceive Bitcoin to a large degree. Jump out, sell off. Oh my God, I just realized this is exactly what everybody needs in a time of war. And then this massive rebound. And every one of these crises I look at, I just go through it, and it's like all roads lead to Bitcoin at the end. It's just there may be, for either hours, days, months, or potentially years, there's a kick in the nuts, and then Bitcoin should absolutely do very, very well. What are your thoughts on that?
It's exactly how I see it too, and I think it is the narrative is changing a bit. And we've both talked about this before. We see it as a safe haven asset, but the markets still have treated it like a risk asset. But I think that's changing, and actually, you can show that it's changing. The correlation between Bitcoin and like Nasdaq stocks, which was really tight for the last couple of years, has actually been breaking down somewhat over the last couple of months, and the correlation between Bitcoin and gold has gone significantly higher. So people looking for a sound money alternative, safe money, hard money, that's what people care about right now, and those things tend to trend higher. When people get scared, they're starting to flock into the dollar, gold, and Bitcoin right now, which is pretty interesting. And the dollar itself, after having that amazing run higher to 115ish or so, is still down. It's still been lagging hard down to 101 right now. So I'm not sure quite what it's going to do. I do think if we did have a big deflationary bust at some point, like the recessionary bear market kicks in, people get really scared. People tend to sell anything and get dollars if they can. The dollar tends to find strength in those times, and basically any sort of risk asset tends to do poorly. But I agree with you. If that pulled Bitcoin down, I would see that as a massive buying opportunity. I do think based on the cycles, so 4-year cycles, I think we're in basically month 5 of the next 35-month Bitcoin bull market. So we're going to have down months for sure, down weeks, down days, all that kind of stuff. But when it's in a bull market, I think dips are for buying. That's what you do in bull markets, right? In a bear market, rips are for shorting. In a bull market, dips are for buying. So if Bitcoin and or gold were to take any significant correction, over the coming days or weeks, personally, I'll be buying.
Yeah, I definitely think that a lot of the risk on dollars have exited Bitcoin, which leaves the holders, the strong hands here are the ones who see it as a risk off asset, and the risk on dollars have left to a large degree. So it'll be interesting to see if those people who were risk on begin to see it and jump on board later on down the track. I think I'm a little different to you. I think the rest of this year, for me, the Bitcoin price, I'm thinking more choppy sideways, maybe even down a little bit here the last 6 months over summer. I think we've probably got a little bit more, not too long left in this kind of uptrend. I see a little bit of a choppy sideways situation for the next 6 months, but 2024 and 2025, I think, will be pretty typical of the 4-year cycle. It'll be a good year followed by an amazing year.
Yeah, and I actually agree with you. I should have made that clear. Bitcoin had its rip higher, which I think was based on global liquidity, really ripping higher basically from October of 2022 through kind of February, March of this year, 2023. Since then, liquidity, and most people are all talking, nobody was talking about liquidity 3 to 4 months ago. I learned about it, and I spout off all the time on Twitter and during interviews and things. So now I hear lots of people talking about it. Lots of people are all on board now, and they're telling me now that liquidity's back, and so that's great for risk assets, and it's great for Bitcoin. But what I've seen is that liquidity actually peaked in about February or March, and it's been coming down substantially, both here in the U.S. And worldwide. And so after that initial jolt of liquidity, risk assets and Bitcoin don't have that underlying base support of liquidity anymore. So when I look at that, that makes me actually pretty bearish for the coming months. And then when I see that what's coming up in the U.S. with I think all signs are pointing towards a significant recession sometime in the second half. You couple all that together, that does not bode well for risk assets at all. And even though Bitcoin is more of a safe haven right now, and people are kind of flocking to it because of what's going on with the banks, it still can't help but getting sucked down, right? I mean, if everybody's panicking, especially if people are getting margin called, they need liquidity right now. That's one of the fantastic things about Bitcoin is it operates 24/7, 365. It's massively liquid, very easy to get access to. People will sell their Bitcoin if they need liquidity right now, so that will hurt the price in the short term. But again, I treat that though, even so. So I think I agree with you. From here, choppy sideways is probably the most likely. It could get pulled down pretty substantially. I would look at that as a buying opportunity though, but I would think of it makes a great trade for the rest of this year. But if you get to these peaks where it's getting overbought, I would recommend to people, it may be time to lighten up a little bit, because it could go down 50-60% from some local peaks. And if you can endure that volatility, great. If you're not and you're more inclined to trading, then maybe consider, trading it a little more than just holding it.
Gotcha. Let's talk about, you mentioned recession earlier. It seems to be the consensus. Certainly the yield curve is telling us that, recession's coming pretty soon. And those numbers that you talked about in the very first thing, the market believes that a recession is coming. Are you in that camp? And if it is coming, how are you looking to profit from that? Are we selling puts? Are we shorting? Or are you doing anything? What are we doing?
Yeah, so yes, I do think it's coming. So I'm sort of loath to hold anything because for the long term, and in fact, I look for opportunities to sell and move to cash. So in our interactive brokers accounts, we have a yield on the cash of like 4.3%. That's fantastic. So if I can, do I want to just sit in cash and earn 4.3%, or do we want to be in stocks, which I think probably are more likely to go down than up? I'm going to take the 4.3%. So I'm waiting for things. We had, like I said, that nice liquidity surge that lasted for about 6 months, and now that has rolled over and is heading down both globally and in the U.S. So I think that as things hit their trailing stops, I'm going to be selling, sitting in cash, and then more to your question, shorting things that look particularly weak. So I already have. We're shorting U.S. small cap stocks. They've rolled over. They're actually negative for the year. NASDAQ stocks are up about 20% or so. Small caps, they've taken the hint. They always take the hint. They know what's going on with the U.S. economy, and they know what's going on with liquidity, similar to Bitcoin. So they've taken the hit. They've rolled over. Oil, for its part, has rolled over. Copper has rolled over. Those kind of things are great signs. They're great clues to see where the economy is going, and they all suggest that for the near term, at least, I think lower is more likely. So that's why I'm playing higher cash positions, short positions, and just kind of wait it out. And at the bottom of this, which I think we do get a bottom in the market sometime this year, that's going to be the time to really load up. Everybody will be scared. There'll be blood on the streets. People will tell you you're crazy for buying anything. And I think that's going to be the time to buy back into a lot of these things.
Yeah, I think my strategy is very much aligned with yours. All right, sir. Thank you so much. I appreciate that. Like and subscribe, and we will speak to you soon.
Thanks, Max.